Business and technology. We have covered till chapter 12. So let's discuss about chapter 13. Chapter 13, 14, even 15. They are linked with financial accounting as well. If you are taking financial accounting along with BT, these chapter will be easier for you. If you are not taking financial accounting, there will be a little bit difficulties, but we will explain everything. So chapter 13 name is accounting and finance within a business. We are learning about business. So in this chapter, we will learn how accounting finance work in the business. I mean, what is the role of accounting and finance department or function in the business? What is meant by accounting? What is accounting? Recording and summarizing financial transactions. Instead of reporting and analysis, we can say summarizing financial transactions. Mean the financial transaction performed by a business to record them and summarize. Summarize mean to prepare financial statements according to those transactions is called accounting. How we can record? We can record through double entry, prepare ledger, that is recording. Summarizing, preparing financial statements. So what is the function of accounting in business? To manage accounting function in a business, there is a finance director. Under finance director, there are different managers. There are different persons who are managing different functions of accounting. There is one person called chief accountant or accountant, whose main role is to prepare financial statements as well as help the company auditor in audit. There is one person called treasurer. Treasurer means cash and finance manage. Cash and finance management is called treasury. What he will do, he will manage a company debt strategy, mean whether company should go for loan or not. If company have obtained a loan, the installment of the loan, the interest payment, he will make sure. Currency management, mean how much cash company should keep in hand, how much cash company should keep in bank account, who will manage treasurer. Working capital management. Working capital means short-term cash flow that can be managed through inventory, through receivable, through payable. What is inventory? The stock that business sell to the customer. What is receivable? Customer who bought goods on credit will be called receivable. Payable, supplier from whom you have bought goods on credit. So managing inventory, receivable, payables, that is called working capital management. Investment appraisal. If business have made some investment in different companies in a deposit bank saving accounts, so that will be called investment appraisal. Our business going to start a new project? How much money is required for that project? How to allocate money in different stages of the project, that is called investment appraisal. Banking forecasting. Banking forecasting mean relating to future. How we gonna manage bank account in future. Internal financial structure. Internal financial structure mean business acquire money either through share, mean by issuing shares, or business can acquire money by loan. So whether business should acquire money through issuing shares or by taking loan, treasurer will decide. And risk management mean the business is facing different risk. How to manage those risks? How much money business should kept as a reserve to manage those risk? Who will decide? Treasurer. And there is another person called a tax manager who will prepare company tax strategy. Tax strategy means how to minimize the tax, how company can minimize the tax. How company can minimize the tax? There are different techniques that you will learn in taxation paper. Like instead of recording all the sale in one branch, spread your sale in different branches. Because if you spread in different branches, there will be lower profit. If profit is low, you will be paying less tax. Tax mitigation mean how company can mitigate, mean resolve tax issues, how company can comply with the tax laws. Who will decide? Tax manager. There is another person called management accounting. Management accountant mean your paper management accounts. What's the purpose of management accounts? Preparing budgets, forecasts that will help the management in decision making, like management information and accounting, budgeting and forecasting, internal financial structure and control, and investment appraisal mean if company going to start a new project. So to analyze that investment, how company can generate a break-even point or profit. So the financial accounting function is concerned with the production of annual financial statement in accordance with the relevant accounting standard and legislation. It is compulsory for listed companies, they need to prepare financial statements. And financial statements are prepared as per accounting standard, as per laws. Who is responsible? Accounting department. Whenever a business transaction take place, such as the sale, purchase, or payment of an expense, there is a need to record the transaction in the organization accounting records. And transaction is first entered into books of prime entry. There are different books of prime entry. Sale day book, purchase day book, sale return day book, purchase return day book, cash book, petty cash book, and the journal. You will learn these groups of prime entry in financial accounting paper. On a regular basis, often daily, weekly, depending upon the volume of transactions. If there are more transactions, you have to record on daily basis. If there are few transactions, you can record on weekly basis. The day book are totaled and these totals are entered into ledger account. And from ledger, company prepare financial statements. So at the end of accounting year of the business, the balances is calculated on each ledger account. Those balances are used to create financial statements of the organization. What are the different components of financial statements? Statement of profit and loss account, statement of financial position called balance sheet, and statement of cash flow. There are 5 account heads: assets, liabilities, expenses, income, as well as equity called capital. So income and expenses are recorded in statement of profit and loss account. Assets, liabilities, equity are recorded in statement of financial position in balance sheet. And all the cash items relating to all these 5 accounts head will be recorded in cash flow statements. Examiner could ask in a MCQ in profit and loss account, what are the account heads are recorded? Income and expenses will be recorded in profit and loss account. Assets, liabilities, equity are part of statement of financial position in balance sheet. The normal sequence of steps in the accounting function mean for every transaction we need to record in day book, mean books of prime entry. From day book accounting entry, we prepare ledger, and from ledger transactions are recorded into financial statements. Why do business need to prepare financial statements? There are different users of financial statements. Owner means shareholders are the user of financial statements so that they can check performance and position of the business. From where we can check performance? We can check performance from statement of financial position, a statement of profit and loss account. From where we can check position of the business, statement of financial position. Mean what are the liabilities? What are the owned assets of the business? Managers need financial statements so that they can compare current with the previous to see whether they are improving business performance or not. Bank need financial statements. Why? Because they are going to lend money to the company. So they need to see financial statements. If company performance is better, this means company will be able to pay loan amount back. If performance is poor, there's a risk loan amount will not be recovered. So bank need financial statements, see financial statements for lending decisions. Employee need financial statements. Why? Because they are attached to the organization. Their life is attached to the organization. So they want a surety whether company performance is better. This means they can maintain long-term relationship with the company. Because company is stable, employee are stable. If companies are not stable, employee will also be affected. Suppliers and customer also see financial statements. Why suppliers see? Because he is providing goods on credit basis. So he need to check performance of the company as well, because if company performance is better, he will be able to recover his amount. Customer also see financial statements. Why? Because they are buying from this company. So they need to see financial statements. If company performance is better, this means they can create long-term relationship with the company. Mean they can buy, they can meet their needs on long-term basis with this company. If company performance is poor, might be company will shut down in future. This means they have to arrange any other supply. Government need financial statements. Why? Because if company paying a tax to the government, how government can check whether company is paying correct amount of tax? Through financial statements profit figure, because tax is calculated on company profit. So these are the users of a financial statements. Companies must send a copy of their financial statements to each of their shareholder at the end of the year. And large and publicly listed companies are also required to appoint external auditor. External auditor, a person who will check financial statements and give audit report on the financial statements, whether financial statements are true and fair or not. Each year and give an independent opinion on whether financial statements have been drawn up properly and they give true and fair view or not. What is integrated reporting? A company produced annual reports every year. Every year, a company produces its annual reports. In annual reports, company publish financial statements. In annual reports, company chairman and CEO provide their statement, like from how long they are with this company and what they have done for best of the company. They need to provide their statement. In annual report, all directors should also provide their statement. Mean what they have done in best of the company as well. In annual report, if company have performed any social responsibility, mean company have done something for the society. Like for local community, you have provided some donations. You have built a sports complex. You have provided some more employment opportunities. So that is called social responsibilities. Our company have done something for the betterment of environment. Like to reduce environmental pollution, company have invested into new machinery. Along with using resources, company has invested in reproduction of resources. So that should also be reported into the annual report. So what integrated reporting concept says, company should not only report its financial statements and the annual report, They should also report chairman CEO statement, director statement, as well as a social and environmental reporting should also be there. How company managing its risk, they should also report risk management as well. So that shareholder aware about everything about the company. So many organizations adopt integrated reporting approach, which means that their financial statements cover the organization financial performance and position using three primary financial statements, but also report on other relevant information that would be interest to the user. What could be the other? Social environmental report, director statement, chairman, CEO statement. The relevant information might include major risk the organization faces and any action they have taken to deal with these risks. In how business managing its risk, the organization performance regarding ethics, corporate social responsibilities, and the organization performance with regard to sustainable development being environmental responsibilities. Along with financial statements, company have to report their social responsibility as well as environmental responsibilities as well as risk management. Now moving towards another concept called management accounting. That is relating to management accounting paper. If you are studying with this along with BT, so you can understand the reason what's management accounting. It's internal accounting for management purpose. What is financial accounting is external accounting for publication, financial statements, while management accounting means preparing budgets. What is mean by budgets? Plan about future. Plan or target about future. So what in management accounting is carried out to assist management in discharging their duties to plan, direct, and control the operation. In management accounting, help the management in making decisions, in preparing future plans. Financial accounting is compulsory. Is the difference between financial accounting and management accounting. Financial accounting is for external user, while management accounting is for internal users, mean for management, planning, and decision making. Purpose of financial accounting is to record and summarize the financial transactions, while purpose of management accounting is to help management in planning, controlling, and decision making. Financial accounting is legally required, while management accounting is not legally required. It's on the management. If they need help in decision making, they can prepare budgets, forecast. Otherwise, there is no need. Financial accounting format is according to standard, according to law. How company should prepare financial statements, standard law will define. While there is no format of management accounting, it's on management how they gonna prepare this. Financial accounting financial statements contain only financial information, while management accounting include financial as well as non-financial information. While preparing financial statements, you need to show current year figure along with the previous year figure. This means financial accounting is historical in current year as well as previous year. While management accounting is not historical, it is based on future forward looking mean you are preparing your future plan based on this. So it is forward looking rather than historical. So management accounting, it is concerned with the process of measuring, analyzing, interpreting, and communicating information to management in a form of which is easy for them to understand. Management accountants will use financial accounting records as a source of data for their work. What is budget? Plan, target, or we can say estimation of future income and expenses. What could be our future income and expenses? Company prepare budget so that they can compare their future actual results with budget. to see whether we have performed as per target, as per plan or not. How budgets are prepared? If suppose company past 5 years sale has increased by 12%, what company will do? They will add 12% to current sales. This will be their budgeted sale, mean future sale. If cost of sale has increased by say 8%, they will add 8% to current cost of sale. That will be budgeted cost of sale, mean future cost of sale, and sale minus cost of sale is equal to gross profit. They will also find the trend of operating expenses. If suppose operating expenses has increased by 10% in past 5 years, they will add 10% to current operating expense. So they have defined budgeted operating expense, and through this they can calculate budgeted profit. Mean the management accounts are prepared based on the past data, means the financial accounting data used to prepare future budgets. While there are no legally required format for management accounts, and three of most common are cost schedule, budget, and variance report. Mean these are three main components of management accounts: cost schedule, budget, and variance report. Budget we have discussed. What is that? Target or future plan. What is variance report? Comparison of actual data and budgeted data. Mean at the year end, company will compare actual results with budget to see whether we have achieved as per budget, mean plan or not. If actual are more than budget, this means company have overachieved. If actual are lesser than budget, this means company have underachieved, mean performance is not good. There's another component of a management account, cost schedule. Cost schedule, what is cost schedule? To produce one product, what are the costs included? So the detail of one product cost is called cost schedule. The detail of all the cost included in production of one product is called cost schedule. So that according to cost schedule, company can decide how much price they should offer to the customer. Through cost schedule, they can check from where we can reduce our cost. Through cost schedule, they will be able to analyze whether we should produce this product ourselves or we can buy from any other company from China, which is most beneficial for the company. So what is cost schedule? Cost schedule is a list the various expenses, mean cost involved in manufacturing unit of a product. And this is often known as a list of the cost incurred when making a unit of each type of product we make. And this may be called a standard cost card as well. The other name of cost schedule is standard cost card. Mean all the cost included in one product is called standard cost card. And there are three types of cost included in a product. One is called material. Other is called labor. And overheads. Overheads mean expenses, other expenses like electricity, rent, etc. And this cost schedule help the business in decision making. Like through this, business can make a pricing decisions. Mean through cost, they can define price of their product. Cost is 10 and they want to make a profit of 10%. So they will set 11 price. If they want to make 20% profit, they will set 12 price. Through cost schedule, business can analyze break-even analysis. What is break-even? No profit, no loss situation. No profit, no loss. And if cost is 10, what could be the price of break-even? 10. Below 10, there will be loss. Above 10, there will be profit. So through cost schedule, business can identify what is their break-even analysis. Through cost schedule, business can check key factor analysis. What is key factor analysis? Whether we should produce this product within the business or we should buy this product from outsource, mean any other supplier which is cheaper one. Suppose if business can produce this product by themselves at a 10 cost, but they can buy this product from China on 8.5. Whether they should buy or produce by themselves, they should go for buying from other suppliers in outsourcing because that is more cheaper. Through cost schedule, business can make investment appraisal decision. Investment appraisal mean to produce this product, business use machine. If business install a new machine, that will be more cost effective. The old car and new car. Old car consume more petrol, new car consume less petrol. Old car CC are more. Nowadays, all car manufacturers producing the similar car in a lesser CC engine. If the engine is low, they will consume less petrol. In old car, there was no system of economy, eco, like especially 2010 before cars. After 2010, there is a new technology, eco technology. Eco technology means car will consume less fuel. So in the similar manner, if business improve their machinery, they will consume less electricity. There will be less wastage. So per unit cost can be decreased. So through cost schedule, business can make investment appraisal, mean investment in assets, investment in machinery, how much cost we can reduce by installing new machinery. Obviously, installing new machinery will require huge investment as well. So whether there is a benefit more of huge investment or lesser. So business can make this decision through cost schedule. What is budget? Estimation about future. This shows the total planned revenue and cost for our business for the coming period. I mean, this is a target that we give to our managers. You need to achieve this. And we will compare actual performance against budget to check performance. What are the uses of budget? Budget uses are trumpet. Trumpet mean budget help in coordination. Mean while preparing budget, if you have prepared budget, your departments will make sure how to work together. Through budget, you can make your manager responsible because you have given them the target. So to achieve target, they will focus on that. So they will become more responsible. Through budget, you can utilize your resources properly, especially the cash resource, because you have prepared a plan where we need to use what kind of money. Through budget, you can motivate your manager and staff because you have given them the targets. So they will be motivated. We need to achieve this. And while achieving, there will be satisfaction. That satisfaction will create more motivation. If there are no targets, they are having no satisfaction that we have done something. And if there is no satisfaction, there is no motivation. Budget help in planning as well because they are future plan. Budget help in evaluation, like evaluating performance of different managers. Like if they have achieved the budget, this means their performance is good. If they haven't achieved the budget, their performance is bad. So through budget, you can communicate to others what we need to do, mean what we need to achieve. So these are the uses or purposes of budget. But major drawback of budget is that they are only estimates of what will happen in the coming period. If in future the circumstances are not like previous, they might not be achieved. It's just a prediction. It's just a prediction about future. In reality, most business will not perfectly achieve the target set out in their budget because circumstances could be different. If there is corona, you will not be achieving anything. So this means that they will have to prepare a variance report at the end of each period. What is variance report? Comparison of actual performance with budget, so that they can check whether we have achieved or not. So a variance report compares the budget to the actual results achieved for the budget period and identify any significant differences, variance between the two. Variance means difference between the two. For control purpose, management may need to establish why a particular variance has occurred. Once the reason has established, a decision can be taken to what, if any, control measures might be appropriate. I mean, if target is not achieved, management will find the causes why it's not achieved, so that they can take steps to overcome those problems. Prevent adverse variance from occurring again in the future. They will take steps. Repeat a favorable variance in the future if you have achieved actually is more than budget. They will try to improve those things more so that next company can achieve even more. And being actual results back on course to achieve the budget targets. If it is similar, they will keep calm. If company achieve their budget variance, that will all may be favored now. It's better if actual results are equal to budget. If actual results are greater than budget, this is also bad, because if actual are greater than budget, this means company have used more resources, and that will create a problem for the coming year as well, because you will be having less resources. Obviously, actual lesser than budget is bad. What is better? If actual are equal to budget. Are slightly above budget, that's fine. But too much above budget, this means you have used more resources. So management accounting and business policy and performance. So management accounting function has particular important role in formulating, implementing, controlling business policies and performance. I mean, they are important. The accounting function can clearly contribute to this process. Obviously, management accounts are prepared on financial accounting basis. Since the achievement of an organization plan is usually measured in monetary terms, accountants are needed to help establish objective and then evaluate various possible strategies. I mean, who prepare management accounts? Ultimately, accounting function. Once a strategy has been selected, such as launch of new product, business must carefully monitor and control to ensure it is being implemented properly, performing the desired results. What's the difference between management and financial accounting? We have discussed. Now we are moving towards discussing what is the treasury department function. Treasury means cash and finance management. So treasury management in the corporate handling of all financial matters, the generation of external and internal funds for the business. Business generate funds internally from profit, and external from shareholder or bank lending. The management of currencies and cash flow and the complex strategies, policies, procedures of corporate finance is called treasury management. The key role of treasury management are they need to manage working capital. Working capital means short-term cash flow. And how business manage short-term cash flow through inventory, through receivable, through payable. If business have invested too much money into inventory, that is not good, because your cash is stuck into inventory. If your receivable are more That is not good for the business because your money is stuck with customers. But payable more are better because you have received the goods from the supplier, you haven't paid the money, you will pay in future. So that will help you to manage your cash. So what business want? Inventory balances should be low, receivable should be lower, but payable should be more, but not too much more. Otherwise, supplier will not give you products on credit. So this is called working capital management. In how short-term cash flow will be managed through inventory, receivables, and payables. Business will prepare strategies how to reduce inventory, how to reduce receivables, and how to increase payables. Cash management. How much cash business should keep in hand and in bank. Or cash, if you are short of cash, you can manage through bank overdraft. What is overdraft? If your bank balance is zero, bank allow you can still withdraw money from bank. That is called overdraft. Your account balance will become negative. What you will do? The next deposit will clear the negative balance first, and then your balance will become positive. So if bank have allowed you, you can withdraw money even if your account balance is a zero. That is called overdraft. It's a short-term loan type. Financing decision, business need to manage how business need finance, from where business can take finance either by shares issue. Business can take finance, or business can take finance through borrowing. Borrowing means through loan or through debenture. What is share? It's a piece of paper that business issue to shareholder and take the money. If shareholder need their money, they can sell that share piece of paper in the market in stock exchange. Shareholder cannot ask the company, okay, take this share back and give me your money. No. If they need their money, they cannot ask the company, they need to sell that share in the market. Either on the same amount you have bought or on higher amount or lower. What is the loan? Company have obtained an amount from the bank. That company need to pay to the bank after that given time period, either 5 years, 3 years, 1 year, or 10 years. And also company need to pay interest. What is debenture? Debenture is also a piece of paper that company have issued to different people and took the money as a loan. And issued for 3 years or 5 years, after 3 years or 5 years, people will hand it back this piece of paper to the company, and company will pay their amount back. And against debenture, company will pay them interest as well on yearly basis. So debenture is borrowing. From where? From public. Loan is from bank. So this is called financing. How financing is managed, from where company can take finance either through issue of shares, that will be called equity. Share, issuing share is called equity, or borrowing. Borrowing means loan or debenture. Foreign currency, if company is involved in import and export and currency rate are fluctuating, how to manage that? That is called foreign currency. It's a role of treasury department. Or managing tax, how company can minimize the tax liability. It's a role of treasury department. Because in tax, company is paying money. So how company can pay minimum tax money? Who will decide? Treasury department. What is working capital? Managing inventory, receivable, cash, as well as payables. The treasury and finance function is responsible for deciding on appropriate level of investment in working capital. How much money business should invest in inventory, how much money business should stock in receivables, and how much money business should gain from payable. That is called working capital management. For inventory, customers are happy as they can be provided with the goods quickly. If business have spent too much money in inventory, so through this business can make quick deliveries to the customer, because all the time you are having inventory available. If you have invested a lower amount in inventory, then in case customer have made a big order, but you are not having inventory because you have invested lower amount in inventory, this means you need to arrange or produce. So through this, you cannot make quick delivery to that. So if a company is holding less amount with inventory, less risk of obsolescence cost. And if you are holding more amount in inventory, there are more chances your inventory become obsolete. Obsolete mean out of fashion, out of technology. In that case, you have to bear the losses. If less amount in inventory, there are chances of less obsolete damage inventory. Receivable. Customer like receiving credit. If you have adopted a policy, more amount should be invested in receivable. This will please the customer. Customer will be more happy. If you have decided no, in receivable, we should invest little amount. So this can affect the customer. Might be customer will be moving towards any other company because you are not providing them more credit. But if you are providing more credit to customer, there are chances of irrecoverable debt, mean bad debts. Mean your amount will not be recovered. Cash. If you are keeping more cash in hand, this means creditors will be happy because you are paying them money because you have cash available. But more cash can be invested elsewhere to earn profit. This means you are not investing cash anywhere. You are just keep cash in your pocket. That is of no purpose. Trade payables, preserve your own cash, mean if there is more payables that will help you in managing cash. But if you are having more payables, that will affect the supplier. If you ask more credit from the supplier, they will not provide you more discount. So there are issues with inventory, receivables, cash, as well as payables. Evaluating and obtaining finance, so company can obtain finance either through debt mean borrowing mean loan or issuing debentures, or through equity mean by issuing shares. So the organization may need additional funding to allow it to grow and invest in a new project. In why business need finance? To invest in different projects. It may need to raise finance from external sources. There are two main type of external finance. What is internal source? Profit. External, debt or equity. What is that? Debt involve borrowing cash from third party and promising to repay them at a later date. Normally, the company will also have to pay interest on the amounts borrowed. There are various sources of debt that an organization can raise a fund from, including a bank loan, overdraft, venture capitalist. Venture capitalist mean different private organization provide you loan, and through selling bonds or debentures. Mean issuing piece of paper and taking money and paying interest. And after 5 years or 3 years, they will give back your paper and take their money back. The main advantage of raising cash through debt finance are interest payments are allowable against tax. Mean if you are taking money through debt rather than equity, the interest expense you will record in profit and loss account that will reduce your profit. And if your profit is low, you will pay less tax. In equity, you cannot take tax advantage. While in debt, you will record interest as expense that will reduce profit as well as tax amount. So this is the benefit of a debt. I mean, you can take tax relief. Note that dividend payment against equity means share we pay dividend. We never ever record a dividend as expense while calculating profit. Made to shareholder by contrast are not allowable deduction, mean there is no benefit of tax on dividend. Raising debt finance does not change the ownership of the organization. Like if a investor is having a 50% shares of the company, and if company have issue new shares, this 50% will be reduced to 45%. If a shareholder is having more than 50% shareholding, he can decide company future. He will be involved in company decision making. He can change any decision of the company. But if he is having less than 51% holding, he cannot involve or influence company decision. And if company is issuing new shares, then his holding will reduce to below 50%. But in case of debt, shareholder holding will remain same. His power will remain same. So this is another advantage of a debt. Debt tend to be cheaper to service than equity, mean debt is less costly than equity. Because while issuing shares, company need to bear some cost. What are the costs? You cannot issue shares by yourself. You have to involve some of the brokers in issuing shares. And to brokers, you need to pay commission. That's why issuing a share is most costly than debt. In debt, there is no cost involved. You just need to negotiate with the bank. If bank approve, you can take loan. You don't need to pay any commission to the brokers. So it is the advantage of debt. Debt is less cheaper than equity. So as it is often secured against assets of the company and it takes priority over equity in the event of business being liquidated. The debt holder mean lenders, bank, they will get advantage through debt as well. Because if company is going to solvent, mean closing its business, first debt holder will be paid by selling asset of the company. If there is anything left, that will be paid to the shareholder. So the advantages of debt are we can take a tax saving in case of interest payments. The advantages of debt is there is no change in ownership of shareholder. Debt is cheaper than equity, as well as debt holder will get fast than a equity holder on winding up of the company. Winding up mean when company closes its business. What is equity? This involves selling a stake. Stake means share in the business in order to raise cash. For a company, this involves selling shares to either new or existing shareholders. And raising equity finance have following advantage. What are the advantages of equity? There is no minimum level of dividend that must be paid to shareholder. If there will be profit, we will pay to shareholder. If there is no profit, we are not paying anything. While in case of debt, you have to pay interest. Either you are generating profit or not. If you are in losses, you have to pay the interest. So this is the advantage of equity. Like in case of losses, you will not pay anything to the investor. Dividend need not be paid if profits are low. Interest payments on debt must be paid each year. A bank normally requires security of the company asset. Mean while making loan decision, bank requires some asset as a security. If you don't have security, you cannot take loan. While equity holder, shareholder don't require any security. You don't need to keep your asset to the investor. This is another advantage of equity. Some companies may lack quality assets to offer, making equity more attractive as it does not require any security. the function of a treasury department is to determining business or tax liability. There are two ways to reduce tax. One is called tax avoidance and one is called tax evasion. Tax avoidance, according to rules, you can save tax. According to rules, if you are saving tax, that is called tax saving or tax avoidance. If due to non-compliance with the rules, mean due to fraud, you are saving tax, that will be called a tax evasion, mean theft of tax money. Whose money? Government money. And tax evasion is illegal. If you are found guilty, you will face fines, penalties, imprisonment. While tax avoidance, according to rules, is legal. And there are certain rules. If you are following those rules and have saved tax, that is called tax saving or tax avoidance. If by non-compliance with the rules, through fraudulent activities, you have saved the tax, that will be called tax evasion, and that is a criminal act, illegal. So one of the role of a finance and treasury function is to calculate the business tax liability, in how much tax company should pay. And they try to minimize that amount for the organization and mitigate or reduce that liability as far as possible with the law. Tax avoidance is the legal use of rule of tax regime in laws to one's own advantage in order to reduce the amount of tax payable by means that are within the law. While tax evasion, theft, is the use of illegal means to reduce one's tax liability. For example, by deliberately misrepresenting the true state of your affair to the tax authorities. Have to finish. Please answer MCQ number 1. MCQ number 1.
One. Option A. Option A.
Consider the following two statements regarding management accounting function. Variance analysis enable business to identify budget. Yes. Management accounts follow a set predetermined format as laid out in relevant accounting standard. No. Format. So which is correct? Option A. Conservative managers will have a policy of holding a large working capital balance. Why? We can meet balance. They will hold less. We will manage. We don't need to try. It bad and out. So there will be no chance of it because they are in the 3 years attract more customers. They are increase inventory sales By not keeping money in inventory, there is no chance of inventory obsolete losses. Increase risk of inventory outages. Outages mean shortages. Yes, because if they are not putting money in inventory, there are chances of inventory shortage. Customer making big order, but you don't have inventory. So conservative mean
Yes.
more
Four X.
inventory and more receivable. While aggressive mean
Less inventory. It's
less
24
inventory and less receivable and more payable. Aggressive strategy. Number 3. Either from that the third one the answer will be by a project. Through that, they will produce some product that will be selling for 5 years. Mean in 5 years, they will generate profit. We're trying to decide whether the launch should be financed using a 5-year bank loan or through raising equity through so the and that's not and it's the answer can read but it will help you manage more than anyway. It's important. See, it should be chosen as is being used permanent increase for 5 years. We did not require to point that we need to participate. These are wrong. So what is correct option? Option B. Number 4.
Option C, business tax packages. It's a financial accounting, not financial stats.
So in management accounting, which is not prepared. So budget we prepare, investment appraisal we prepare, variance report we prepare, business tax calculation we prepare in where financial accounting. Number 5. HGK Limited is looking to raise additional finance to enable it to open a new store. They need finance for investment. Which of the following are advantage of HGK raising the finance via debt? Advantage of debt. Interest payment can usually be delayed if the company is unable to afford them. No, you cannot delay them. You have to pay. Debt is often considered to be a better source of finance if the return from the project is uncertain. No. In that case, equity is better. Debt finance tend to have a higher annual cost than equity. Debt is having more cost than equity. No, equity is more costly. Debt holder are paid before equity holder. Yes, in case of company is going to be liquidate, winding up, debt holder will be paid first after selling asset, then equity holder. So will be paid before equity holder in the event of company being liquidated, reducing the cost of finance. Yes. Number 6, please.
Option D.
Which is legal? Tax avoidance, tax saving, and which is illegal?
Tax evasion is illegal.
Tax evasion.
Tax evasion. Tax what?
So one is tax evasion
One is tax avoidance.
and two is tax avoidance. Where is evasion? B and D. There is no minimization. So D option. You know? Okay. Moving towards next chapter. Chapter 40. Financial system and procedures. Financial system and procedures. I mean, in this chapter, we will learn different system of the organization and their procedures. Procedures mean controls. Controls mean policies, procedures. So let's discuss our sales system. In how company record sales, what are the documents that are prepared in our sales system? When a company receive order from customer, company prepare a document called sale order. And company keep record of this document. This is a proof like company have received the order from the customer and all the detail, how many units he have ordered, what is the price per unit you have agreed, when you need to make delivery of this order, all the detail is mentioned on this document. That's why company need to keep it in record. If there is any issue, you can show as a proof. This was the number of units, this was the price per unit, and this was the delivery date. And against this order, company will deliver goods to the customer. Along with delivery of goods, company send a note called dispatch note. Also called goods dispatch note, GDN. And company send 2 copies of GDN to the customer along with delivery. 1 copy customer will keep for his record, and second copy he sign and return back to the company. And we will keep that signed copy as a GDN in our record because that signed copy is a proof that customer have received the goods. If there are no signature, customer can deny in future, I haven't received the goods. Sale order. And then what's the document? GDN, good dispatch note. And then company prepare another document called a sale invoice. Bill that we will send to the customer. Please pay this amount against your order that have been delivered to you. And against sale invoice, company will record accounting entry in a sale day book. And what is the accounting entry of sale? Debit receivable, credit sales. Mean through accounting entry, company will update ledgers. What ledger? Receivable ledger, as well as sales ledger called sale account. So while receiving order, company have prepared a document sale order. While delivering goods, company have prepared a document GD and good dispatch note. And then bill is called sale invoice. Against that bill, company have recorded entry, accounting entry in day book, and company have posted to the ledgers. Then company will receive cash, mean receipt from customer. Against that receipt, what company need to do? Company need to record that receipt in cash book, like cash has been received. And accounting entry is cash debit, receivable credit, and company need to update receivable ledger as well. And when a company have receipt from the customer, company need to record in a daily receipt list. Like these are the receiving for the day. And these receiving should be promptly banked. Promptly banked means company need to deposit into bank on quickly basis, because if you keep cash within the company, there will be chances of misuse of cash. That's why these receipts should be deposited into the bank account. So this is the system of recording the sale. Until this point, we have recorded sale, and below this, there is a cash receipt system. Now we need to learn what are the controls, policies, procedures in this system. The control policies. The control, while receiving order from the customer, company need to check stock availability. If we are receiving order of 90 units, whether we are having 90 units in our inventory warehouse or not. Because if you haven't checked the stock availability, you have received order for 90. While delivering, you found, oh, there are 70 units. This means for 20 units, you have to produce or arrange, there will be chances of delay in delivery. And if there is a delay in delivery, customer can charge you damages because you are not meeting his requirement. So that's why while receiving order, we need to check stock availability, whether we are having that number of units in our stock in our warehouse or not. And we need to check customer credit worthiness. Because if we are selling goods on credit basis, we need to check whether this customer is credit worthy or not. He will be able to pay this amount in future or not. If he is not credit worthy, there are chances of bad debts, you will not be able to recover this money. How we can check customer credit worthiness? From his past record. If in the past he has made payment on time, this means his credit worthiness is good. For new customer, we can ask him, okay, send us your bank statement. Through bank statement, we will see if there are so many inflows, outflows. This means he's having good cash repute. So he is credit worthy. Or we can ask different credit rating agencies like banks about the credit worthiness of the customer. So while receiving orders, what are the controls, policies, procedures? We need to check stock availability and we need to check customer credit worthiness. Dispatch note, what are the controls? Must have customer signature. If in your record there is dispatch note, but there is not no customer signature, you don't have proof that customer have received the goods. So must have customer signature.
Dispatch note will go.
We will send 2 copies of dispatch note to the customer along with delivery. One he will keep in his record, and second he will sign and return back. And that return back copy signed we should keep in record as dispatch note file. While preparing sale invoice, we need to match this invoice with order and GDN. Why? To make sure the price we agree while receiving the order, we are charging that price. And the number of units customer have actually received or we have delivered, we are charging those number of units, not more than that, not less than that. Is that fine? These are the controls relating to sales. We are also going to learn controls relating to cash receipt as well. So the cash should be recorded in daily receipt list. The cash should be promptly banked. And while receiving cash, there should be 2 persons present. Because if there is 1 person, there are chances of misuse of cash. He will put into his pocket and will not record into the business. If there are 2 persons, one for receiving, one for recording, there are less chances of misuse. Though 2 persons can collude with each other to make fraud, but there are less chances.
Yes.
Because 2 wrong people, 2 corrupt people will never go together long time. One day will come, they will be having problem with each other and they will be disclosing their issues. So that's why there should be 2 persons present while receiving cash. And against cash receipt, we need to update the cash book as well as receivable ledgers. So these are the controls relating to sales system. I mean, what documents prepared in sales system, what are the controls, and what are the controls relating to cash receipt. Let's read few things. Overview of system. I mean, in this chapter, we're gonna learn about a different system. We will learn about a sales system. We will learn about a purchase system. We will learn about a payroll, mean wages system. We will learn about inventory system. We will learn about cash payment as well as cash receipt system. In cash payment and cash receipt. We have just discussed the sales system and cash receipt system. So accounting system lay down procedures, policies, and guidelines that reflect the company's policies. And these terms are explained as system, policies, procedures, guidelines. What is meant by system? A group of independent but interrelated elements comprising a unified whole or a process for obtaining an objective. Policy, principle. Procedure, series of acts or set of sequence steps that company need to follow. And guideline are recommended approach for conducting a task. Mean you need to prepare all the documents. System could be either formal or informal. What could be the advantages of formal system? Formal mean having rules, informal without rules. So there are several advantages to having formal documented system. What are those? All transactions will be recorded in the same way and required information will be recorded in the correct place. The best practice, the more efficient way of a recording transaction can be adopted. Staff can refer to the written procedures if they are in doubt as to what to do. Mean they will be clearly aware what should be done, how should be done. And a new staff can be trained more quickly because they will be adopting same procedure that everybody else is following. And the auditor can follow transaction more easily, mean auditor can also conduct their audit through document easily. If there is informal system, no documents available, this will affect the auditor in performing his audit role as well. Transaction which have not followed the procedure, which could record error, fraud can be identified easily. In informal, you cannot identify fraud errors easily. Designing financial system, each system is made up of series of procedures. The system designer will need to first consider the objective of the system. Mean why we need to check stock availability while receiving order? To avoid late delivery penalty. Why we need to check customer creditworthiness while receiving order? To avoid future bad debts. Why we need to compare sale invoice with the order and dispatch note? To ensure invoices are accurate. Why there should be two persons while receiving cash? To avoid misuse of cash. So there are some objective in the reason behind the policies procedures. So objective to record the value of sales to each customer and amount outstanding to be collected. That's why there should be sale order as well as customer creditworthiness check performed. Output and analysis of sale by date and product type are reports showing amounts owing the receivables and how long outstanding. That's why we need to maintain receivable ledger. And a customer place order by fax or by telephone through sale order, we can identify when he made the order and how he made the order. The designer then need to consider the most likely consequences of event from input to output. So what could be the objective? To receive and process order quickly and accurately. To ensure that goods are only dispatched where the amounts charged will be collectible. Instruction to dispatch department to dispatch goods. Instruction to accounting department to invoice charge for the goods. Detail of order may be lost if you don't have a sale order document prepared. Detail of orders may not be passed on dispatch or invoicing if you haven't prepared the sale order document. An order may be processed from customer who is unwilling, unable to pay. That's why you should have proof of customer signature on dispatch note. Shall we take a break? Take 20 minutes break. After break, we will discuss about purchase system, payroll, inventory, and cash system. Okay, we have discussed about sales system, and also we have discussed about cash receipt system as well. Now moving towards purchase system. So let's discuss what could be the purchase system. So when company made order to supplier for purchases, they prepare a document called purchase order. And company need to keep record of this document. And when supplier send you goods, along with goods, they will send you a note called delivery note. And we will keep this note as a GRN, good received note. In against in sales, there is a sale order, while in purchase, there is a purchase order. In sales, there is a dispatch note, good dispatch note, while in a purchase, there is delivery note called GRN. And then supplier will send us invoice that will be called purchase invoice. According to purchase invoice, we will record entry into purchase day book. And the accounting entry for credit purchase is purchases debit payable credit. This means we need to update payable ledger and we will update purchase ledger called purchase account. And in purchases, we will make a payment to the supplier. While making payment, we will record entry in cash book and we will update the payable ledger. Payable debit, cash, credit. So these are the documents similar to sales system. We have just converted the sales system into purchase instead of sale order, purchase order. Instead of good dispatch note, there is good received note. Sale invoice, purchase invoice, ledger receivable, sales, not payable purchases. And instead of receipt, there will be payment to supplier. But there is one more new document before purchase order that will be called purchase requisition. Purchase requisition. What is that? Purchase requisition. Purchase requisition is authorization or approval for purchase. Authorization or approval for purchase from top management. No purchase order should be made without purchase requisition, mean authorization approval for purchase. So that ordering department cannot make order for goods of their personal use. Top department, top management will see whether these orders are necessary. They will raise purchase requisition. They will issue purchase requisition. They will sign, and only then ordering department can make purchases order. To avoid business liabilities or to avoid personal use goods order, there should be purchase requisition. So this is a system of purchases. What documents are prepared? Purchase requisition, purchase order, GRN, purchase invoice, and then entry into day book and ledgers, and then payment. Let's discuss about controls in this system. While making orders, orders should be made by obtaining a quotation from approved suppliers. In company should obtain quotation from different suppliers, like we want to buy these goods. So different suppliers will send you their quotation. And company should make sure who is the supplier providing a high quality at lower price. You should make order to that supplier. If you are making order without obtaining quotation, you are missing high quality, low price. And while making order, there should be authority levels and limits established. Authority levels are limits should be there, like up to what amount maximum ordering department can make order by themselves. And above that order, there should be approval of a finance director. Because finance director will see whether companies are having that much finance available or not. And while receiving goods, to prepare GRN, company need to perform quantity check, quantity check, and company need to perform quality check. What is quantity check? Company need to count the inventory that they are receiving and match that quantity with the note, whether note is stating similar number of units. Because if you haven't performed quantity check, might be note is saying 90 units while delivery guy have delivered you 86 units. Who will bear the 4 unit loss? You. If you haven't checked, you haven't performed this quantity check while receiving the goods. While receiving the goods, company need to perform quality check, like the units you are receiving are not damaged, they are accurate units. Because if you have received the damaged units, you will bear the loss for damaged units. You will not be able to return them. You will not be able to explain that you have received damaged units. So if they are damaged, don't receive. And for invoice, obviously, you need to compare with order and GRN to see whether same quantity, same price is charged. So these are the controls relating to purchase. Let's discuss what could be the controls for payment. Payment should be authorized by two persons.
Authorized by 3%.
Mean one person should not be authorized to make payment. There should be two signatories. Like chief accountant should approve payment and then accountant by signing the check should make the payment. If there is one person, payment could be misused. And while making a payment, you need to check the supporting document. In this payment is going to be made against what? Against this purchase invoice. So while making payment, you need to check the invoice. Not only you need to check, you need to cross cancel the invoice so that it should not be coming for double payment. So while making payment, there should be two signatories who authorize the payment. And supporting document should be cross cancelled checked while making payments. So let's read about purchase system. So purchase system, requisition. Staff decide what goods or services they wish to purchase and produce a purchase requisition. And authorized by the departmental supervisor means should be signed by the departmental head. Ordering. Department place order with the suppliers, approved suppliers that company have prepared a list and a quotation to get most competitive prices. And may be authorized specially if for larger amount, for larger amount, finance director approval is necessary. And while receiving goods, inspect to ensure they are in good condition, quality check and quantity check should also be performed. And for invoice, supplier bill company for good services, so recording the accounts and checking to ensure goods were received, compare with GRN and order. An invoice should be recorded into the accounting system, either manual or computerized. And payment made, a check is produced for amount owing. This will be approved for payment by senior manager, two persons should be signatories authorized. And detail of the check agree with the invoice, supporting document should be checked while making payments. And these are the sales system controls. Depending upon the business, order may be received by post, fax, telephone, in person, electronic through email. A record should be made of incoming orders so that a check can be made. While receiving order, ensure that customer has a valid credit account. Check should be made that goods are inventory, means stock availability. And order confirmation may be sent to customer detailing when the goods will be dispatched. Mean for order confirmation, you need to send confirmation to the customer. And goods are sent to the customer. A good dispatch note is produced, which will be signed by the customer. And invoice should be matched with dispatch note and order. Invoice should be recorded into the ledger. And payment is received while receiving check credit transfer from the customer. Control should be placed to ensure there are 2% present, and receipt should be promptly deposited into the bank. Okay, now we are going to discuss about payroll system in wages system. There should be time sheets recording the hours of employee works. Mean at the start time, that is called clock in, and leave time, that will be called clock out. And their sick leaves, holidays should all be recorded on time sheets. And company need to prepare a file for each employee. From that, we can obtain detail of their pay rates. We can record their pay rises. We can record their holidays, leaves, detail, etc. And through employee file, pay rate will be taken. And from their time sheets, hours worked will be taken to prepare the payroll, mean wages. And from wages, company need to deduct a tax that a company will pay on behalf of the employee. And then employee net pay will be calculated, that will be provided to the employee. And company need to prepare payroll reports for management purpose, for record purpose. Along with the pay, company need to pay a pay slip to the employee. Pay slip is a detail of his amount of payment. Mean what is his gross pay, how much tax is deducted, and how much company paying to him, mean net pay. The detail should be provided through pay slip. And company need to make a payment to employee, and company need to pay tax to the government authorities on timely basis. So what could be the controls in a wages system? Hourly paid employees will be record details of hours worked. This is done by using clock in, clock out system or time sheets. And hours worked are usually authorized by the supervisor. Like employees are working under supervisor, so supervisor should make sure that employee have worked these hours. Salaries employees may receive additional pay for overtime, and overtime rates normally are more than the normal rate, either double or 1.5, when they submit a timesheet with the detail of the extra hours worked. And pay rate obtained from their file, either monthly or per hour. And this information can be obtained manually by pay clerk using the manual system or computerized system. And when pay rates are changed, they must be recorded into their file. And how pay is calculated? Hours multiplied by rate. Through this, we can calculate monthly pay. And from gross pay, we need to deduct some securities for tax, for social contribution, and then net pay should be calculated. And net pay will be paid to the employees either by cash or directly into their bank account. And if company is paying through cash, and on the day company is paying salaries, wages to the employees, if any employee is absent, his wages should be securely placed. If you are not securing place, that could be misuse. And what is the system for cash receipt and cash payment? For cash receipt, checks are received from credit customers and recorded in cash book. The cashier then pays the check into the company's bank account, mean he need to deposit into the bank. Control must be in place that the check cannot be misappropriated before it is paid into the bank, having two persons present while receiving the cash. Some customers may pay money directly into a company bank account, so that should be recorded properly. And for payment, companies pay their supplier usually monthly by check. A check requisition is prepared for each payment, from which details the reason why check is required, mean invoice you should check while making payment. A check will be prepared and the check requisition and the invoice will be paid by submitted by senior manager, and approval mean there should be two signatories. And check for larger amount of money will usually require two signatories. There's another term called petty cash. What is this petty cash? Routine day-to-day expenses.
Channels are very slow.
Routine day-to-day small expenses. For that, company need to set an amount. Like suppose in previous month, your routine day-to-day small expenses were suppose 1,000. This 1,000 will be called petty cash. What company need to do? Company need to hand over this 1,000 at the start of month to the clerk, so that clerk will pay for these small expenses from this 1,000. Suppose during the month, the total expenditure are 850. This means clerk is having 150 left. So at the start of next month, what the company need to do? Company need to provide 850 more, so that at the start of the month, he should be having 1,000 to make expenses for the month. This 1,000 that you have set are routine monthly expenditure, that is called float. And at every month start, you are checking how much money is left, and you are making the float by paying the extra money. So this system is called impressed system of petty cash. Impressed system means where at the start of every month, you are paying the amount to clerk to maintain the float, that is called impressed system. And float is a fixed amount that you have calculated are your monthly expenditure.
You call that interest amount.
Interest amount as well. So what is petty cash system? Companies will need to keep certain amount of cash on hand to pay for small expenses such as postage, biscuit, taxi, fares, etc. A check will be made out of cash at the start of every month to generate the initial cash for the system in float. As a staff claim against the petty cash system, they complete vouchers stating what a payment is for and attach receipt to prove the amount. Mean clerk will pay expenditure from this float, and he need to maintain records like voucher receipts, etc. So at regular intervals, a further check is made out to cash to replenish the petty cash which has been spent. Mean every month you will give the check for remaining amount. The supervisor will inspect the receipt and vouchers at the point. Now moving towards discussing the last system of this chapter, that is inventory system. Inventory means stock. There are three types of inventory: raw material, work in progress, and finished goods. Suppose we are having a furniture business. Mean we manufacture furniture like chairs and then sell. What could be our inventory? We are having wood to make the furniture that is called raw material. We are having some incomplete chairs, like chairs only frame without the foam, without the arm, that will be called a work in progress. And the complete chairs that we sell to the customer, that will be called finished goods. So raw material we purchase from supplier and finished goods we sold to the customer. But our inventory is of three types, including raw material, including work in progress, and including finished goods. All these three inventory we will add together. And suppose the amount of all these three is 1,000. And out of 1,000, we have sold for 800. So the remaining 200 will be called closing inventory. In the record, it's showing 200. But company need to verify whether we are having 200 inventory or not. How? They should physically count the inventory in the warehouse. And then they should compare with the record whether we are having 200 inventory in warehouse or not. So the inventory system is really several system which can be summarized as follows. The production manager will decide on the required inventory purchase, bearing in mind the items to be produced and the inventory balance on hand. Mean the purchase raw material, incomplete items, and complete items. All will be part of inventory. In some automated system, raw material will be ordered automatically when the balance fall to a certain level. Mean company need to set their lowest inventory level, like for 300 units, we should keep inventory at all time. If inventory balance below this 300, system should highlight so that they can order more inventory from the supplier. So that minimum level is called reorder level. Yeah. The goods are received and are stored in a raw material store. When goods are required for production, the production manager completes a material requisition from and gets the goods from the store. The goods are then made into work in progress, mean partially completed goods, incomplete goods are eventually converted into finished goods, and the length of this process depends upon the type of item being produced. When the goods are sold, a record must be made of quantity removed from the inventory, and the remaining will be closing inventory. So at the year end, all inventory, raw material, work in progress, finished goods will be counted and valued so that statement of financial position can be produced. Because in financial statements, we record closing inventory only. So organization need to set some policies like controls for sales system, for purchase system, for inventory system, for cash system. There should be some controls. What is the purpose of controls? Through controls, company can safeguard asset, like they can save their asset inventory from stolen or damaged. I mean, there should be some CCTV cameras, there should be security guards over high value inventory and asset. Company can achieve efficiency through controls, mean company can avoid losses, wastages. Through controls, company can prevent fraud. Through controls, company can prevent errors and produce true financial statements. So these are the purposes of control policies. Why control in system are important? In purchase system, controls are important so that company asset can be safeguarded. Company can achieve efficiency, company can prevent fraud and errors. In sales system, again, company can safeguard assets. achieve efficiency, prevent fraud and errors. Again, in wages, cash system company can gen- obtain, achieve these objectives. To keep records, company use either manual system or automated mean computerized system. Mean in accounting department, either company keep manual accounts or company keep records in computerized system. The computerized system are of two types. One is called bespoke, also called tailored made, also called custom built, also called customized. The other system is called off the shelf, generic, another name is there, packages. The system company used for accounting are of two types, means software are of two types. Some softwares are already available in the market. Company can buy through a CD and install into their system to use them. Mean they have been already designed by any company like Microsoft Word, Excel. So those are called off the shelf generic R packages. Sometimes company ask any software house to design a special software according to the requirement of the company. So that will be called customized, custom built, tailored made according to company system or bespoke. There are different advantages. The bespoke tailor made system, if you have designed according to your specification, so there will be some problem, there will be some bugs, error initially. That will be resolved after 5 to 6 months use of the system. For bespoke, your staff might not be trained. You need to provide a training to the staff. For bespoke, you cannot implement system quickly because software house requires some time for system design. And they are normally costly as well. So bespoke are costly, training is required, and time consuming to implement. While off the shelf are cheap, you can buy from CD from the market. No training is required because the staff have already used somewhere or have learned during their studies like Microsoft Office, and they can be implemented quickly, and they are having a strong controls. Mean there is a no issue because their updated version mean the problem has been resolved fully. QuickBooks Zero are packages. QuickBook, Tally, ERP, Microsoft Excel, they are off the shelf generic R packages. So automated system, mean if company using computerized system to manage their accounts. Automated computerized systems are nowadays used by most organizations with the exception of a very small, because small normally keeping records manual, large organization moving towards computerized system. Large companies will have accounting software specially written for their needs like bespoke, whereas the small companies will purchase a standardized accounting package that has been written to suit any company like off-the-shelf packages generic. Automated systems show the following features. Mean if company instead of manual using computerized system, what could be the features of computerized system? Mean there could be some benefits, there could be some problems. Uniform processing transaction mean through automated system, all the transaction will be recorded in the same manner. In manual, might be transaction are recording in different way. Lack of segregation of duty. Mean in computerized system, there is only one person who is doing every task. While in manual system, there could be different persons. And if one person is doing all the tasks, there are chances of fraud as well. He can change the design of the system. This is a problem with automated system. In automated system, there is a problem of data corrupted. Like if your system crash or hacker hack the system, so data can be corrupted. Any virus can affect all the data. While in manual, there are less chances of data corruption because data is available in files registers. In automated system, there is a problem of more supervision. Like you need to make sure unauthorized users should not be having access to the system. If any unauthorized user having access to the system, they can make big fraud. While in manual, you can keep record into a lock room. Nobody will be having access. So automation, this is the advantage, but this could be the problems. The record maintained under manual and automated system are similar, but the use of an automated system allow the data to be analyzed more easily in a variety of ways, mean there will be less human errors and you can perform calculation quickly. What are the advantages and disadvantages of manual system? Obviously, if you are moving towards software, you have to bear software cost. In manual, it will be less costly. No computer experience or training is required for the user. In accounting staff, don't need to be trained how to use the software. Easy to correct errors because if in computer you have entered the wrong amounts, wrong transaction, it is very difficult to trace and correct them. In manual, you can easily find the errors and correct it. And ledgers are portable. In manual, you can move from one to another location easily, while computerized, the file data is too much. You need a high memory space to move from one location to another. And can review transaction for logical sense, mean in manual, you can perform review of the system, you can perform review of the ledgers easily. While in computerized, you cannot see into the system how transactions are processing. But there are disadvantages of manual system. Calculation will take a time while computerized system can make calculation quickly. More likely to make a calculation errors. There are chances of human errors in a manual calculation, while in computerized, there are no chances of human errors. Calculation will be accurate. Analysis of information is more time consuming in a manual. Mean you cannot analyze the data quickly. You have to go through all the pages. And in manual, there is disadvantage of less easy to audit, while in computerized through audit software, auditor can perform audit quickly as well. So these disadvantages are the advantages of automated system, like quicker to process transactions, fewer human errors, data is more secure. Using password, you can secure the data, and easier to sort out and analyze the data, like you can calculate different ratios in the system more quickly. But there are disadvantages of automated system. For software, you need to bear the cost. You need to train your staff. And if anything entered wrong, you cannot identify and correct easily. And a system could be hacked, could be crashed. In that situation, you will lose all the accounting data if you are not having backups of the system. Chapter finish. MCQ number 1, you are given the following extract. The clerk multiplies the hours worked by the hourly rate to determine the gross pay. What does this extract describe? A system, policy, procedure, or guideline?
Policy.
Is that policy?
Procedure.
This is a procedure. This is a procedure that you have followed to calculate payroll.
Procedure.
Number two, A is trying to design a system for the processing of orders from customers. Sales system, purchase system. Sales system. Which of the following is not likely to be an objective of this system? To ensure that orders are processed promptly. That's why you are designing a order from customer. Yes. To ensure that goods are only dispatched to customer who are likely to pay. No. To ensure that all orders are recorded. To ensure that customer sign to accept the goods.
Yes.
Yes. So what is
Option B.
B? Mean all the other are purposes of sales system. Which of the following is not a stage in a standard purchase system? Receipt of goods. In purchase, we receive the goods.
Yes.
Receipt of cash. In purchase, we pay cash rather than receipt.
Yes.
Placing of orders, yes. Matching of invoice with orders and goods received, note, yes. Number 4. Consider the following stages in inventory control system. Transfer to warehouse. I mean, after receiving the inventory, we need to transfer to warehouse. Requisition of raw material before placing order. Year and inventory count. Purchase of raw material. Can you make order of 1, 2, 3, 4? Which should be first, which should be after that?
Position of the inventory.
First, you will issue requisition.
Then particular.
Next, you will make a purchase mean order. And you will transfer to warehouse at year end. You will calculate count inventory.
Option C.
So 2, 4,
3, 1.
2, 4, 1, 3.
2, 4, 1 plus. 4, 1, 3. Yeah. Option. 4, 1, 3. Option D.
2, 4, 1, 3. First, you will issue requisition. Then we will make order mean purchase. And then we receive, we will transfer to warehouse. And at the year end, we will count the inventory. Is that fine? So 2 will be first, then 4, then 1, then 3. Number 5. Which of these controls relates to the sales system? Matching of cash payment to invoice received. No, payment are in purchase rather than sale. Calculating overtime payment. These are in payroll system rather than sales system. Authorization of requisition form.
Yes.
Requisition is in purchase rather than sale.
Sales.
Matching of cash receipt to invoices sent. Yes. Number 6. Which of the following is not a feature of an automated system? Uniform processing of transaction? Yes. Lack of segregation of function? Yes, because one person is doing everything. Reduced chance of data corruption? No, there are more chances of data corruption. Potential for increased management supervision? Potential for increased management supervision? Yes. You can implement password, so there is more chances of data corruption rather than less chances. Let's move towards chapter 15. It's a small chapter. We're gonna cover it now. Just 2, 3 pages. What's that chapter? The relationship between accounting and other business function. Mean how accounting department help other departments. Mean accounting department is linked with other departments. How they help other departments. What is the link? We're gonna learn now. Purchase department, also called procurement department. What is the difference between purchase and procurement? There's a difference between purchase and procurement. The purchase word is used for buying inventory, while procurement word is used for buying assets. In capital nature, asset buying is called procurement, while revenue nature like inventory buying is called purchase. So the purchase buying function is responsible for placing and following up orders. It coordinates with the accounting department as follows. Establishing credit terms. In accounting function will inform the purchase department how much credit we should gain from the supplier. In how many days credit we should require from the supplier, 30 days or 60 days, accounting department will inform according to working capital management. If we are receiving from customer in 60 days, but paying to supplier in 30 days, is that fine? No, we should ask the supplier, we will pay you after 60 days. So accounting department is having link with purchase while negotiating credit terms with the supplier. In accounting department, we'll see its working capital, and then they will provide information to the ordering department so that they can negotiate with the supplier while obtaining quotation. They will see who is the supplier who is providing more credit terms. Prices mean at what price we should buy the material from the supplier. Accounting department will inform. How? According to previous prices. Previously, we bought this material at this price. We obtained this much discount. Now you should go for this. Payment. While making payment, accounting department will provide information. In fact, payments will be made through accounting department for purchases. Data capture, for example, orders, because accounting department need to keep detail of orders. When we place the order, when we need to make the payment. Inventory, obviously accounting department need to prepare financial statements. So they will take data from purchase department, how much inventory you have received so that they can add to the inventory ledger. And budgeting, to prepare future budget, what could be the future purchases? They need information from where? Purchase department. Production department also have link with accounting department. I mean, what information is shared between production and accounting department? Cost, measurement, allocation, and absorption. What is the cost per unit? Accounting department will receive this information from where? From production department. How much material is used in one product, how much labor is used in one product. Accounting department need to calculate the amounts. They will provide the material in kg. They will provide the labor hours. So accounting department will calculate the amounts. Budgeting, to prepare production budget for future. Accounting department need information from the budgeting production department whether production is able to produce that much goods or not that are planned. Cost versus quality mean if we reduce quality, how much cost can be saved? Accounting department need this information from production department. And inventory, how much inventory they have produced during the year. How much inventory is left, how much inventory in work in progress, how much inventory in finished goods. It's with the production department, but accounting department need this information so that they can calculate inventory. Because for finished goods amount is different, for work in progress amount is different. Marketing department coordinate with accounting department to prepare marketing budget. They need to discuss with marketing department in how much money you need for the future to meet your target. Advertising mean how much money should be spent on advertising. Obviously, marketing people will provide the detail. We need this money for billboard, this money for social media marketing, and then accounting department will calculate total advertising expenditure. Pricing mean marketing need to attract the customer through setting the price. What could be that price? They need information from accounting department. I mean, what is the minimum price business can afford? In which business is meeting its cost as well as minimum profit. Because if they are having information about the cost, from where they can get information of cost from accounting department. And market share. Share mean number of customer. To prepare future budget, prepare future plan, accounting and marketing department work together. How much market share we can increase in future? Because through market share, they can calculate future sale volume. Different departments provide services as well. If organization not producing goods, they are providing services. What are the main features of services? Services are intangibility. Intangibility mean cannot be touched, cannot be seen. Services are inseparability, mean cannot be separate from the person who is providing the services. These are attached to the person. Services are perishability, mean if one person is not work according to his skill for some time, after some time that skills become lost. Because if I don't teach this subject for 6 months, after 6 months, I will forget the even chapter name, even the concept. So services are perishable, mean if a person do not work, his services quality will become low. Services are variability, mean no one individual can provide services like other people. Different individual provide same services, but different quality, different level. Two individuals cannot provide the services in same way, same manner. Goods can be produced same, but services cannot be provided same. Even one day services and next day services might not match with each other. So intangibility mean cannot be seen and touched. Inseparability cannot be separate from the person who is providing services, mean you cannot store. And perishability mean lost skills become weaker if you don't provide regular basis services. And variability are different from one individual to another individual. The relationship between services department and accounting department. Service department need to make sure the rate of services from accounting department, per hour rate, per week rate, for the complete day rate, what could be the rate that should be charged to the customer. Estimating cost mean you are paying to the staff who is providing services on hourly basis or monthly basis, and accounting department will calculate the cost of services if you are using staff who provide services, especially the accountancy firm using different accountants. Problem of measuring the benefit mean if a service department is facing any problem, how to resolve that problem, how much cost will be there to resolve the problem, who will provide information, accounting department. Mean they need any equipment to resolve the problem, they need additional hours to resolve the problem, who will calculate the cost, accounting department. Chapter finish. Let's discuss MCQ. MCQ number 1. Which of the following is an example of coordination between the purchasing and accounting department? Establishing credit terms?
Yeah.
Yes. Determining sale prices? No, that will be between sale department and accounting. Allocating cost? That will be production. Calculating pay rises? That will be payroll and accounting. So A is relating to purchase and accounting. Number two, which of the following is not an example of coordination between the marketing and accounting department? Review cost benefit of advertising. This is coordination.
No.
Pricing.
Yes.
This is coordination.
Yes.
Assessing market share.
Yes.
Yes. Assessing creditworthiness. No. Sale department and accounting will assess creditworthiness with each other. Number three, which of the following is a likely advantage of providing a good service?
Great customer satisfaction.
Great customer satisfaction, higher payroll cost. No. Higher inventory turnover. Economies of scale.
No.
Great customer satisfaction. Number four, most services provided by an organization will be created at the same time as they are consumed. Which feature of service is being described? Intangibility,
No.
inseparability,
Yes.
perishability, variability. Inseparability means because they cannot be stored, they cannot be separate from the employee as the time he is providing services. Services can be used because they cannot be separate from the person. That's it for today. We have covered three small chapters today. Chapter 13 was a little bit longer, 14 shorter than 13, and 15 very small chapter. So see you in next class with chapter 16.
All right.